I'm naturally more biased towards investing in the REITs simply because we are all shaped by our own experiences, correct? If you have bought a BTO before and when you sell it, you see gains, you believe in property. Or if you bought in cryptocurrency many years ago, now you see some gains, you naturally believe in cryptocurrency. So in this topic, I'll be trying to force myself to look more from the point of investing in commercial properties individually. There could be points that I've missed out before because all I have is research as well as hearsay from friends who have bought before commercial properties. So I'll be looking to learn also, and in this journey, I'll be inviting you to leave your comments just in case I missed out some points or got some points wrong. If you are also a learner on this subject, do look to the comment sections. Hopefully there'll be some gems for you. There'll be a bonus towards the end of this video, so stay on for it. Let's roll in the intro video and start on 3 key points that you should hear today. Let's touch on the first key point between REITs as well as investing yourself in a commercial property, which is this: leverage. Now, some people say that REITs don't have leverage, but that's actually not true. REITs, just like any business with financial leverage, have something inbuilt into it already because they take on debt, correct? And for REITs, there's actually a limit set by MAS, which is 50% currently. But most REITs, if you do a survey, they are actually about 40% gearing ratio, which means 60% equity and 40% debt. So naturally, there's already a leverage factor when you buy a REIT itself. And if you're keen to increase the leverage that you get when investing in REIT, simply invest in REIT with a margin. What that means is use $1 to buy $2 worth of REITs. And if you understand that 60% is equity, that actually means that your $1 is buying $3.33 worth of property. So hopefully that gives you a sensing that REITs can also be levered up. Not that margin account is something that you should pursue right away. There are also merits if you invest into REITs and invest REITs with margin if you know what you're doing. But commercial properties, when you invest yourself, can even be higher. So this is actually a screenshot that I've taken doing a Google search from iCompare Loan. And it mentions that the maximum loan to valuation is set at 80%. But financial institutions will take a holistic approach in deciding whether to grant you 80% or not. Actually, a friend who bought an industrial property, and from what he has shared, the gearing was 70%. What that means is that if you have $1 and the loan to valuation is at 80%, it means you can buy $5 worth of property. Conversely, if you have $1 and the loan to valuation is 70%, it means you can buy $3.33 worth of property. I don't know if that is the norm, so if you know something more, do leave them in the comment sections. But I've also done further research, and this is something mentioned by UOB. They are willing to loan you 90% for a business property loan. So I'm not too sure what are the qualifying criteria to get 90% loan. It seems like there could be a range also. So if that is true, it's quite possible that you buy a commercial property on your own, you're able to increase that leverage factor by a bit more. And when that leverage factor benefits, naturally you see your gains even more outsized. The second difference between investing in REIT and a commercial property yourself lies in the cost of funding. Now, if you look at REITs like Mapletree Commercial Trust, which is something I cover on this channel, you realize that their cost of funding is about 2.5% thereabouts. But Mapletree is very likely an investment grade, that's why that cost of funding is so low. So what if we look at a smaller REIT like ESR REIT? Now, ESR REIT actually buys into industrial properties in Singapore mainly. I have actually a friend who was working with their finance team before. And what can be seen here is that their cost of funding is about 3.24%. If I know, ESR REIT bond is actually unrated, but this 3.24 cost of funding is still possibly not high as compared to many developers in Singapore, for example. But what about for commercial property when you buy yourself? This is what I discovered. In this screenshot, you realize that you can actually get rates at 1.28%. Now that seems to be significantly cheaper than what REITs can achieve, correct? And Mapletree is so financially sound. How can they borrow at higher cost than you and I? It doesn't seem to be logical, correct? So there are a few points that I can suggest to you to understand this topic a bit better. The first is that when you take a commercial property loan, if you are not an established company, you may have to put in personal guarantee, which means also you need to prove your ability to earn income, correct? And that would naturally add on to your TDSR when you buy a residential property. So you may be required to use a personal guarantee to get that kind of loan. The second is that REITs have locked in some of the rates from previous years before COVID. So if you look at ESR REIT again, some of their bonds actually are at 2.1 years on average. So some of the rates could be old, which also means some of the REITs might still be able to revise their cost of funding lower in the years ahead. But more importantly, the third point is that REITs, they don't actually amortize the loan. But when you buy an industrial commercial property, you need to pay mortgage, correct? Which has interest and principal. So REITs are very different. They don't pay down principal, they pay only interest. And every time that bond or that loan is due, they actually do a refinancing, which naturally means they can preserve more cash flow to distribute out as dividends. So these three could be reasons as to why the cost of funding is lower when you buy a commercial property yourself as compared to a REIT. And I've actually some numbers that I've prepared to hypothetically run through what is the return rate for you. So the first case is that if you have borrowed $1 million at 1.28%, what does it actually mean in terms of the interest cost you're paying? Because if you are paying down principal, that is still okay. So let's only factor on the interest cost. And as you can see over here, it's about 11.5 thousand on an annual basis. And assuming you bought a commercial property yourself and collect 4,000 in rent, that actually means you collect 48,000 in annual rent, correct? And of course, when you buy a commercial property, you also have conservancy charges, you have GST, you have commissions that you need to pay to your agent to get it tenanted out. So factoring all this cost, let's assume that you can collect 40,000 net in terms of rent income from your commercial property. Now, 40,000 is your revenue, but 11.5 thousand is your cost, correct? Your interest cost. That means your net income after everything else is 28.5 thousand per year. But you have to remember, if you bought a property yourself with a loan to valuation of 80%, that means your capital is only 20%, correct? And assuming we add in stamp duties, GST, everything else, let's assume that that total cost that you paid for this property is $210,000. And when you earn 28.5 thousand in rent revenue, your total capital is 210,000. Your rate of return is actually 14.25% for that year. Now that's pretty impressive, correct? Now if you consider most REITs like Ascendus, they pay only 5% thereabouts. If you look in terms of REIT average yield, you realize that it's 5.46%. That means if you invest yourself in a commercial property, you could get 14.25% versus 5.46%. So there's a big difference in terms of real return, correct? And I'll next explain what could change the variable, because again, I'm trying to look from the perspective of investing yourself positively. So now let's do some adjustments. Assuming you can't collect 4,000 in rent, you only collect 3,500 because the commercial property you bought is a bit older and stuff, and there's competition. So assume we got a lower rent, and you actually had 1 month where you couldn't find a tenant. So let's put some risk factors to it. What does the equation look now? So assuming the interest cost is 11.5 thousand per year, and then your net rent is 30,000 after all these costs is factored in. That means that your net rent profit is $18.5 thousand. Now, if 18.5 is your numerator and your denominator, which your capital is 210,000, you realize that your rate of return is 8.88%. Not very nice number, correct? Coincidental, but that is still going to beat REITs by quite a bit, because REIT yield again is 5.46%. So it is possible that when you invest yourself, you can get a better rate of return. So my guess is there could be another factor that could change the equation that we should pre-plan for, which is if interest cost starts to go up, correct? So I've actually gotten numbers for you. If the interest cost is now at 2.8%, you realize that your interest is now at $27,000 on an annual basis. That is assuming if SIBOR goes back to 2%, which is not impossible also. That's happened in 2019. And then we still assume that the net rent that you can get is 30,000 per year. So that means that profit is only left with 3,000 for the year from a capital investment of $210,000. But that could still be over bearish, which means that you face an interest rate rise. You also were unable to rent out your space for a month or two. So if you are actively running that business, managing that investment property well, then these should be avoided. You can actually fix 3 years of your interest cost low. So if you're able to take note of these risks, it's still a chance that when you invest yourself in a commercial property, you could do better than a REIT. The third point is that a REIT actually does all the managing and finding tenants for you as an investor. It's almost hands-free, very passive income. But when you invest yourself, you have to engage an agent, or you have to source tenants yourself, do improvements to the properties yourself. Now for a REIT, it's also not free. When it's passive, there is already some cost factored in, correct? And if you haven't seen numbers, REIT managers actually charge between 5 to 10% of property income as their fees, which they collect usually as units. So that's not even factoring expenses, which is, for example, painting the wall when it's peeling, finding customer service stuff. For example, you own Suntec REIT. You know that there's customer service, correct? You know that they are doing some upgrades to some of the places, correct? So all these costs again is separate from a REIT manager's fee. That 5 to 10% is purely to manage the properties, do buy-sell transactions when opportunities arise. They do the job professionally. On the other hand, if you invest into commercial properties yourself, you have to take note that you need to spend time finding tenants, finding agents, making decisions on what to do to improve the property itself. So it can be done that 5 to 10% can be saved up, and that is substantial. That could improve the performance of the investment itself. So what do you think? Investing in commercial property yourself, is it better than a REIT? Leave your thoughts in the comment sections below. I'll be keen to hear from you also, especially if you are a savvy investor already into commercial properties. Now, if you like this kind of content, smash on subscribe. I'll be launching an idea on residential property pretty soon, next few weeks, and stay tuned for it. Now, as I promised to you, bonus tip that I wanted to share with you, which is this. When you buy properties yourself as an investor, do note that income from there adds on to your personal taxes. That could be a negative point. When you get rent income, that is actually income that you need to declare to IRAS. On the other hand, when you buy a REIT, it's totally tax-free because it's one tier tax. And REITs actually enjoy a concession when it comes to tax. So that could be a factor that still weighs slightly favorable more towards REITs. So hopefully you benefited from this sharing, and with that, let me invite you to some of the previous videos I've done before. The first is actually an idea, especially if you're looking to buy a first home for yourself, what to look out for. So check out this video, Ultimate Guide to Buying Your First Property. The second is if you're keen to invest into commercial properties already, what are some risks? Because this video says on investing without capital down is probably not as good as it seems. So if that, inviting you to any of these videos to help you in your journey further. With that, I'll sign off. Take care and goodbye.